So, hello and good afternoon. I welcome you to today's Trading Spotlight webinar here on Friday. It's the 23rd of October 2020. And yeah, we have a very special, very interesting topic to cover today. In fact, we will look at the question on how the stock market has performed throughout the presidential election year, in fact. And that's, in fact, a very interesting question right now, since the presidential election, US presidential election 2020, will take place on the 3rd of November. So we still have a little more than 1 week to go. So it's not next week on Tuesday, but the week after. Still, I can already say it right here. So there is a chance, in fact, to predict who will be the next US president, who will win this election, given the recent performance in the stock market, in fact. Yeah, so that's the last, it will be the last slide we will cover. So you have to stay tuned to see what the stock market predicts right now. First of all, let's have a look here at today's agenda. So first of all, we want to answer the question, is there something like a presidential cycle? Spoiler, yes, there is something like that. Then we want to also answer the question on how do equities perform during US presidential election years in general, and how do equities perform the year after the US election. That's also something we want to look at here. Probably it's not just interesting to look at the current environment, but also what to expect in the year to come. And I can already say here that next week there will also be a technical piece, or no, it's not a technical piece. It's more like a blog article you will find on the website, admiralmarkets.com, in regards to what to expect for the equity market, not just the economy, but also the market in general, the equity market, if Joe Biden wins or Donald Trump wins. So, I mean, there's a chance to draw a conclusion in each case, in fact. Also, we want to have a look here at the performance the year after the current the year after the US presidential election in the current context. And then we want to see if the stock market can reveal who will win the White House in November, given all this data, if we put this together from a pure statistical standpoint. Before we start, that's me. So my name is Jens. I'm located in Berlin in Germany. And that's probably... Okay, let me just see the question. First question here, which comes up. What happened last night? I have to say, I have no idea too. So I haven't watched this debate after the first debate which took place. So I can't really say that. It was more like a shouting match, the first debate, and then had no real value. So in fact, it doesn't really matter how the debate went. I think in what we want to cover in the upcoming minutes. So let's come back to my person. So my name is Jens. I'm located in Berlin in Germany. If you're interested in my vita, where I come from, how I got started in the financial industry, respectively, how I started in trading, then feel free to check out an interview I did together with Admiral Markets over a year ago, covering exactly that question. The most interesting part, certainly, that I'm located in Berlin in Germany. Why is that the case? Because Admiral Markets is a global financial service provider with not just over 8,000 financial instruments being covered, and really being a multi-asset broker. So not just offering FX and CFD trading, but also physical stock trading for investing purposes. So if someone is interested in longer term engagements and markets, then you should definitely check out the Admiral Invest option on the website, admiralmarkets.com. So Admiral has over 20 offices around the globe, and one is in Berlin, in Germany, in fact. And this is where the connection came to came into existence. And this partnership, Admiral Markets is licensed by but by several regulatory bodies like the FCA, for example, SISEC, but also from ASIC, for example, in Australia. So you can see that Admiral is really engaged in the financial industry around the globe. And this is also necessary, noteworthy probably, due to the fact that you can be really sure that you have someone in your native language answering your questions. And based on my experience in this industry, in retail banking in general, I can say that especially when it comes to financial questions, some people feel way more comfortable communicating in their native language, in fact. And that's a big plus when it comes to financial service providers, in addition to the overall very, very competitive offering Admiral offers in general. So for example, here in Germany, we refer to Admiral as the so-called DAX expert, given the probably most competitive offering when it comes to DAX CFD trading, in fact. So if you're interested, check out the website admiralmarkets.com for further informations. And we want to start now with today's topic, and here with the question: is there something like a presidential cycle? As I already said, yes, there is some kind of presidential cycle, and so what we want to do is here to get an idea of that is we look back of the performance in the S&P 500 since 1928. I have to say, I'm not really sure, but I think the S&P was calculated the way it is right now somewhere from 1950. So probably there's a small adaptation which has to be made when it comes to the S&P 500. But however we put this, the answer, as I already said, is a clear yes. So in fact, when you look at research data, you can see that in 17 out of 23 presidential election years, so 74% of the time, or nearly 3 out of 4, equities, respectively the S&P 500, have traded higher during this year. And currently, the average annual return, the average annual return was 7.1%. Currently, we are up year to date here. So 70%, 74% out of the time. I'm going to say, there, this is the next point. I'm sorry. So I forgot. Yeah. So currently we are up year to date 6.9%. So slightly below the average annual return, in fact. And that's especially noteworthy since we were already down 32% for the year in March after the Corona lockdown. So there has been massive intervention, we have to say, from the Fed, from the US Central Bank, in fact. Which was certainly one main driver for this bullish performance. So the question is certainly if it's a sustainable move, or is it more like, let's say, kind of manipulating market, probably, which probably increases the chances, especially of the incumbent party / Donald Trump, to stay in office. And we will see, by the way, that this is probably a reason. So I mean, it's no big surprise, no big surprise to everyone who's listening right now, respectively probably watching this recording on YouTube, that Donald Trump has an eye for the equity market. So I'm most of the time, if someone asks me, I say, well, I've never seen a politician, or respectively in this case a US president, who has measured his performance as a president in Dow Jones points, but this is certainly what he does. And if you don't if you don't believe that, just check out his Twitter account. He will certainly find some some tweets which clearly give a clear indication towards that direction, or into that direction, in fact. And but let's look at the pure statistics here in this context. So far, everything is as it should have been, or as we should expect it in a U.S. presidential year. So being up on average 7.1%. And in fact, what we will see is here with the next slide, and the question on how do equities perform during U.S. presidential election is, I'm sorry, no, it's the next slide. It's not this slide here, but this is something which is really, really interesting. By the way, I highly recommend following this guy here, Ryan Detrick from LPL Financial in the US. It's a research company on Twitter. If you're on Twitter, just follow this guy, because the statistics he delivers here are phenomenal. They are just great, and we use them not just here in this slide, but also in the later stage of this presentation, in fact. And what he does here is, in fact, he shows how the equity market, in this case the S&P, has performed each month. And what he does is he looks at the pure performance since 1950, in this case, till today. But he also looks at the performance of the last 20 years, the last 10 years, and also how we performed during election years. And if usually you look at the chart, you usually expect October to be a quite strong month, in fact. So, and indeed, so if you look here, the past 10 years alone, February, July, and here October have been extraordinarily strong months, in fact. But this is not the case when you look at election years. So in election years, in fact, October has been the worst month which has ever which you can find here, it's in fact the worst month compared to September, and the third worst month, or yeah, there's only 3 months, in fact, in during presidential U.S. presidential election years, which perform negative on average here. Here the third place is May, in fact. So October is extraordinarily weak usually. Currently, we can see quite stable performance, but it's not extraordinarily bullish too. So it's a quite stable market environment, in fact, and we still have 1 week to go. So if history repeats, and if things play out here as they have going back till the 1950s, then probably October will see a quite weak close into the month, even though there are some indications that this is probably not happening. So, for example, yesterday, therefore, we are not looking at the S&P, but therefore, I look, for example, at the DAX especially. If you have seen yesterday's weak start into the day with a drop below 12,500 points, that was something we could have expected. Therefore, check out the several technical pieces. For example, from the beginning of the week on Monday on the DAX, where this was mentioned, that 12,500, if it breaks, could trigger further weakness and opens the door down to 12,200 points. But what you now can see when looking at the chart, when looking at the DAX, is that we saw a very strong reversal from yesterday already. The market traded already higher several hours later, and today we saw even more bullishness. In fact, probably we have to be a little careful here, because main driver for today's bullish action in the DAX was certainly the development here around the PMIs, respectively the quite solid print when looking at the manufacturing PMIs, even though numbers from the service sector weren't that positive at all. In fact, they clearly show a clear recessive tendency. But in addition to that, there's also hope probably on a deal which is struck between Republicans and Democrats in the US in regard to a relief package, Corona economic relief package, which is somewhere in the range, let's say around 2 trillion US dollars, so quite massive, in fact. And given that alone, and the current difficulties to strike a deal between the two parties here, it's probably another reason, especially if we get a deal struck within the next week then into the monthly close, one reason which could help out here and stabilize the market solidly above the current levels, or at the current levels, in fact, and meaning that this year here before the US presidential election, or as we have seen when looking back down the road till the 1950s, that October posts a quite solid performance, in fact. And so let's have a look now at the next slide. And here in this context, the same question, in fact, the question on how do equities perform during US presidential election years. So we were probably surprised to see here .de. So this is in fact a chart I screenshotted on a German website. But still, we could easily have found this also in the US, in fact. So for example, I've found another website where you can, and just let me probably share this in the chat box here. 1 second. And I will also share this for all people who will listen here to that on or watch the video on YouTube. 1 second, let me go. Let's have a look here. So click. So what we can do here, so there's several of such charts as the S&P performance by president, for example. Also, just to give an idea on how, for example, the S&P here performed. And therefore, what we did is, yes, I agree. No, that's not the right button. 1 second. Yeah. So, for example, yes, I accept the cookies. Thank you. So, what you can see here is the performance of President Trump, for example, and then the two former presidents here, in this case, George W. Bush Jr., and then the performance of Barack Obama. I bet Donald Trump doesn't like that chart at all because Obama is outperforming him. But I mean, what you can see here in this context is that there's plenty of opportunities to draw such charts, in fact, and compare the performance. For example, let's put here Bill Clinton, for example, on top of that. Clinton outperforms also in his second term. Obama, for example, no big surprise, was the second half of the 90s, so 90s. So that means nothing more than he was definitely profiting also from the start of the dot-com bubble in this context. But what we want to look at here is now this chart. 1 second, there we have it. Want to have a look here at this chart, and what we have to realize is this is where we are right now. So we are here at this part. So you can see that the performance, the bearish performance here, especially during the Corona lockdown, is something no one could have seen or foreseen in this context. But the performance afterwards, especially then, starting here from May, respectively June onwards, bottoming out in around the second half into the end of the month May, and then performing significantly on the upside, is quite common in US presidential election years, in fact. And there's also some let's say some solid reason right now to probably consider each pullback which occurs here in the end of the month October to probably to see as a buying opportunity. So from a pure seasonal perspective, in fact. So because you can see that US presidential election years tend to see the so-called Santa Claus rally. So the year-end rally, in fact, taking place. And what certainly has to be seen, this is purely statistically speaking, respectively, purely from a seasonal perspective. What certainly has to be seen is who will be elected. I mean, we certainly agree that it's difficult to say right now, because let's assume that Joe Biden will win the election. So currently, polls indicate that he has an elevated chance of being elected. And I have to say, I somehow shared this point of view. I've seen charts from yesterday, for example, where the situation in, I think, was Kansas. I'm not sure, but I think polls from Kansas. Trump won here Kansas by a wide margin of 20 points or something in 2016 against Hillary Clinton. He's still winning Kansas in 2020 against Biden, but the margin is only 7 points. And this is in general something I have to say, my feeling tells me that the situation can't be compared to 2016. In fact, I think the overall bias among the population, not just in the US, but probably around the globe. Just remember 2016 in June, we also saw the Brexit vote, for example. I quite well remember the skepticism around the euro here in Germany, for example. People were really frustrated, in fact, about the government in general, probably most likely due to the how can we say that, refugee crisis? I'm not sure if this is okay to say that, but I hope you know what I mean. So a decision of Chancellor Merkel, for example, into the end of 2015 in September, back then, to open the borders, in fact, and to also force the Eurozone into potentially also diplomatic crisis, probably. So there was a complete different environment, and many people also in my personal environment were really frustrated about the whole developments, the whole situation taking place here, and the behavior of the establishment, let's call it. So I have to say, I'm quite indifferent to that. I wasn't really frustrated about anything. First of all, my wife was pregnant with our firstborn. I went out to be self-employed, and someone who wants to be self-employed, traders in general, probably, they don't really care about others, but first of all, they care about themselves and make sure that everything's fine, and they take full responsibility for everything which takes place in their reach, let's say, and what they can influence. And so I think the whole situation was completely different back then, and that's one of the reasons why I doubt that Trump has a great chance to be re-elected. and now the question is how much uncertainty will or is in the markets around election of Biden and Trump not behaving the way a loser of an election should behave, but probably fight his where he wants to stay in power. There's some kind of uncertainty which he probably brings on its way to make the transition of his presidency to a Biden presidency, to make it as complicated as possible, let's say. So and this is something which is not necessarily bullish for equities, even though people certainly argue that he's more positive, respectively more bullish for equities, due to all his general behavior in terms of not just tax cuts, but also influencing the Fed, for example, in regards to more monetary stimulus, for example. On the other hand, what counters that point is certainly also the uncertainty among his China policies and tariffs, for example. He probably reinstates, respectively. He probably brings back into play then in the upcoming months in all very, very fragile environment after the Corona lockdown. Then we have Biden. If Biden is elected, markets currently certainly fear that there will be some kind of, let's say, equity unfriendly policy in regards to increasing taxes, for example. Still, I heard that there are several Wall Street firms, Wall Street analysts, Wall Street traders who are more likely to say, well, they expect a win from Biden, and this is mostly priced in, even though there will be, compared to Trump, a more friendly equity policy, which should be expected. So all in all, there's plenty of reasons to draw a picture which is bullish once Trump is reelected, but also bearish. And the same is true for Biden, who will certainly be in stronger and very intensive talks with China in terms of tariffs. Most likely there will be a lift of the tariffs, and all this in combination with a massive fiscal and monetary stimulus from the Fed government, from the Fed, respectively the U.S. government, in combination is probably something which is which is more likely bullish for equities then. So I think we can draw a picture for each of those sides. If we look at purely numbers and what happened over the last years, we can certainly say that if we go back till 1900, in fact, that then we have here certainly a bullish window which opens into the month of November and post the election. So risk reward wise, probably the long side should be favored. But now the question is, okay, this is only the next 2 months, right? So, I mean, this is only November, December. What can we expect in the year to come, in 2021? And there I have also a chart here. This is the seasonality of US equities post the election, so 21. And what you can see is that usually the start into the year is most likely bearish in the first 2 months, and probably even worse than that. That could especially be true if fears around Corona do not vanish, and if markets finally see, this is something I think which is certainly underpriced, let's say, when looking at the current performance in equities, that the overall negative economic impact the Corona lockdown will result into, and many bankruptcies and insolvency in the overall corporate sector, not just in the US, but probably especially in Europe here, with banks potentially facing a crisis, that this is one thing which could certainly then drive equity prices significantly lower, even though we can also see that markets performed quite solidly then over let's say over the second quarter, especially starting or probably till the end of the second, beginning of the third quarter, only then to see that most of these gains of the second quarter were reversed then in the third quarter. But then finally, we also saw again a year-end rally. So this is definitely something we have to keep in mind in the current environment. So if we see markets under pressure, let it be Trump who's elected, re-elected, or let it be Biden, from a pure seasonal perspective standpoint, we should expect equities to see some heavier headwinds, let's say, in the months to come, especially starting in 2021. So there's an elevated chance, especially when looking at the last 100, 120 years and the US presidents which were elected here. So now let's have a look here at now the performance the year after in the current context. So first of all, let's recall that I printed or painted a quite bullish picture for the months months ahead, 2 months ahead, weeks ahead into the yearly close. And this is something which is underlined also here. Once again, this is a statistic which was provided from Ryan Detrick here from LPL. That's also very interesting to look here at the current picture and what we have seen in the months of April, May, June, July, and August. These 5 months have been surprisingly strong over the last weeks. And if you put this into context then and look at when this happened in the past, when did it happen in the past, it's not quite often that these 5 months were positive. So here you can see it's 6 times before this year, in fact. And there has been only 1 year, and that was 2018. We saw a negative final 4-month return. That was only in 2018. Remember, 2018 was a strong bearish window which opened, especially in the last quarter, given and especially the fears of market that the Fed is taking its, let's call it, put away. So the Fed put was not certainly given anymore after they communicated in October, I think it was at the beginning of October, that they are running their reduction of their balance sheet on autopilot. That was a funny time back then, right? So we reduced, and we saw a drop to somewhere slightly below 4 trillion, and right now they increased their balance sheet. They ballooned it to over 7 trillion, in fact, and we should expect further expansion of the balance sheet, which is also one of the reasons why being bullish on precious metals, especially gold, but also silver, probably also Bitcoin and digital currencies in general, is probably quite a good idea, in fact. And in combination with the trade war fears, which also established in 2018 and into the end of the year, and the volatility which was brought on its way from the especially erratic behavior from President Trump. I think this is something we can certainly agree on. That was one of the reasons why here this year, the last time this happened was negative. But usually, as we can see here before, once these 5 months were positive, usually the end of the year was positive too. And have a look here. Currently, from the end of August onwards, we are currently up something like I'm not sure, but slightly up. I think something like 6% or so. I'm not really sure. I haven't checked this up before, but what we can certainly say is this is, by the way, also something you will see this in the statistics in the article I mentioned on Tuesday, which will appear on admiralmarkets.com. There has been an indication that once the performance was better 7% in the last 3 months before the US election. So that means September, October, and then the 3rd of November, starting from the 3rd of September, that if the performance has been greater 7%, that happened 3 times, I think, in the past, going back to 1950. And each time the incumbent president succeeded in the election and was reelected, in fact. But and we're close below that level, so that's why I'm not quite sure. But something between 6.5 to 7%, if I'm not mistaken. And so far, yeah, we are still on a quite good way here to see also a positive yearly and year-end close, in fact. And so that means even though we already have performed 6-7%, probably the upside is limited. Still, we shouldn't rule out that there's further gains to come, in fact, which is also adding to the positive risk reward, I think, we see in the current environment on the long side, in fact. Even though it's not a no-brainer trade, let's say. So we have to be really, really careful, because there are several aspects also in the current environment, the whole context, in fact, which could play out quite unfavorably for such a long engagement, and which should definitely be taken into account. And so finally, let's have a look now at the very interesting question: can the stock market tell who will win the White House in November? And the answer is yes, the stock market can. And now we have a look at the numbers. So if the stock market is up 3 months leading up to the election, so which is not the case anymore because September has been negative. So this is not a topic anymore, in fact. But August, September, and October, if you saw a gain here, you had an 80% chance of Trump winning the presidency, in fact. And in the 22 presidential elections since 1928, in fact, 14 were preceded by gains in the 3 months prior. And in 12 of those 14 instances, the incumbent won the White House. So currently, when you look purely at the numbers from the stock market, we can certainly say, or not certainly, but with a high probability that Trump has a good chance to be reelected. Again, as I already said during the introduction of this webinar, of this video here, the thing is that this is probably something Trump knew before, and also explains why he is right now, at least, working heavily, let's say, on making sure that the overall performance of the equity market stays positive, in fact. So let me just have a look here if I can find some further statistics in the article, which will be published here. If I have a number, I can see here. 1 second. Okay, yeah, that would be probably something which is of interest also, in addition to a slide before. So, can the stock market predict the winner of the US presidential election 2020? Yes, it can. And chances are high that Trump will be reelected given recent performance, in fact. Even though, again, let's look at the numbers in regards to polls right now, its overall performance, the current environment, also in terms of recession fears, for example. There's also something which plays certainly a role here. Just imagine when we go back here to the overall performance here, that the equity in the year after the election, so the post-election year, performed well. There's also another statistic which shows that chances were increasingly high of the incumbent president to be reelected if there was no recession. So chances dropped, in fact, massively that the incumbent president is reelected if there was a recession. I'm not sure about the numbers, but if I'm not mistaken, I think chances that he wasn't reelected were over 50%. That's also something which then also, explains to some extent, I think, why, for example, in the year after the election, if the president in office right now is reelected, why chances are high that the equity market performs well, because, and that's simple to explain, if the economy is running good and it's not in a recession, certainly equities have a higher probability to perform well, right? So, and that means nothing more than, in fact, that if the incumbent president was reelected, that then the 12 months from the election till the next year, so within the next 12 months, that the S&P, in fact, traded on average 9.6% higher, and compared to only 4.8% if there was a new president in office. But this is something, again, which should be taken with a grain of salt, I think, because right now we already try to explain if Biden is elected, why the stock market should not perform well. The most likely reason is because Trump leaves a completely damaged U.S. economy after the coronavirus, and the U.S. being in a recession. I mean, right now we see a global recession, in fact, and so that equities do not perform well in such an environment shouldn't be such a big surprise. And also, in addition to that, by the way, now, I mean, there might be people who are pro-Trump, let's call them. They might say, well, he's not leaving a damaged economy. I think there are certain indicators, especially when looking at the unemployment rate, for example, or in general, the employment situation, in fact, that point that that there is a recession right now in the US, and there's no such thing as a V-shaped recovery. And if we take this and Trump is really reelected, then, in fact, there's also a quite good chance that there will be a very bearish performance in case of the incumbent president then in his, let's say, at least first 12 months into his second term, in fact. Because the thing is, in fact, in over 70% of the cases, 5 out of 7, in fact, the U.S. equity market performed positive. Okay, it performed positive when the incumbent president was reelected. But, and this is the thing, if the other 2 cases, so in 2 out of 7, obviously it didn't work out so well. That was 1956 with Eisenhower being reelected and Nixon being reelected in 1972. In both cases, within the next 12 months, the U.S. economy was in a recession, respectively entered a recession, in fact. And in these 2 cases, under Eisenhower, it was minus 14.3%, and under Nixon, it was minus 17.4%, in fact. The incumbent president took over office for a second term, and equities really broke lower. This is also something we should keep in mind when looking at the current performance. So probably Trump will face a very, very difficult environment, not just from a political perspective, but also from an economic perspective, and also in terms of the overall performance of the U.S. equity markets. And probably when, especially looking at the numbers, I haven't worked them out right now, and I don't want to overload you now with numbers. But the thing is, I think there is a good chance that given the developments back till the 1950s, a new elected president, that the overall performance, purely statistically speaking, of a new president was less negative, was still negative when they went through a recession, but it was less negative than if there was a second term and the incumbent was re-elected, took over, and then there was this recession, respectively. They entered the recession shortly after. The performance overall was quite negative in the upcoming 12 months then, and extended the negative performance of a new president elected in this case then. So yeah, lots of numbers, lots of information. The summary is, again, right now, when looking at the numbers, even though September wasn't a very positive month, but again, when looking at the current performance over the last 3 months, chances are elevated that Trump is reelected. So this is at least what the stock market predicts. On the other hand, it's difficult. If I was a S&P 500 bull, for example, I'd be careful what I wish for, because again, it could also mean that if Trump takes over, there will be lots of uncertainty, probably anxiety, probably fears around a new escalation of trade war with China, especially, which could accelerate a down move, which is certainly a possibility given all the information we just saw. So now have a look here at the following slide, our Trading Spotlight community. And if you have any questions related to trading setups, if you want to discuss markets, if you have questions around trading education, if you want to just share ideas with traders in general, not just traders who are listening to this right now, but share ideas with us, with Marcus, with Paul, and also me, then feel free to join the Traders Yard community here. So it's tradersyard.com group or /group and then /312. And We are already over 200 people within this community, so feel free to join us there and yeah, ask all your questions if you have one, or if you have questions in general. And also, don't forget to join us next time. So at the same time on Monday, Paul will be here to learn to talk to you about the question: what are the most popular traded currency pairs in the world? In fact, so including the question, certainly, which is of high interest: which currencies do professional traders focus on? Especially majors, especially those who have high liquidity, I'd say, also those who are very trend stable. But to find out more in detail, check out the webinar with Paul. He will also answer the question on how can we find out which ones are the most heavily traded currencies. In fact, there was something I just want to say that I just wrote or I received a mail from a client who asked what I was referring to when I talked about the G8FX currency universe. So that was a German question I received, and in 2014 I published a book here in German on forex trading, and there I used this phrase G8 currency a basket, or G8 currency universe, and he was irritated because I was referring to Australian dollar, for example, but also Kiwi dollar, for example, and he said, well, the economies of these two countries alone are just too small, so it's not the G8 in a classic sense, no. And that's exactly true. If you look at the stats from the Bureau of International Bureau Note Bank, I'm sorry, Bank of International Settlements, so BIS, you will find out that Australian, I refer to G8 in context of mostly traded and heaviest volume, seeing heaviest volume. And there, the Australian dollar, for example, after the euro or US dollar, after the euro, JPY, and British pound is in fact in 5th place. And so this is also a question, certainly, which will be answered from Paul on Monday, then in the webinar. And then he also wants to share with you his thoughts on how you can use this information in your own trading. So 2 p.m. London on October the 26th of 2020 here. If you're just listening to this here in real time, then you can just check your inbox for the webinar link. If you watch this on YouTube, if you enjoyed what you just witnessed here, so please leave a thumb up here. Ask your question also in the comment box below. Yeah, I'd highly appreciate a thumb up. And if you want to join the next webinar live, for example, the one with Paul, head over to admiralmarkets.com and there to the education tab, then webinars, and there you can register for free for Trading Spotlight for the webinar series. And admiralmarkets.com is probably the place to run to next and to check out the website and the information here. Here are the contact details from Admiral Markets. And as I said at the beginning, we're talking about a highly regulated broker. That's why we have to place here the risk disclaimer. And that's it from my end. So all the best from Berlin, from Germany. Happy trading. Watch your stops. Talk to you again next week on Friday. I look forward to it. See you and bye-bye.